Warren Buffett once stated, for the investor, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. And basically what he's saying is even if you buy a phenomenal company, if you pay too much, it won't be a good investment. For example, take Microsoft. Look where they were trading at in early 2000. They were trading as high as about $51 to $55 per share. But if we look at where they were trading about 10 years later, it was about half that price, close to $25 per share. Now, there's no doubt Microsoft is a phenomenal company, but it's clear they were trading at way too high of a valuation in the early 2000s, and as a result, over the next decade, they had very lackluster results. But if we look at them over the past 10 years, they've way outperformed the market. So it's clear, valuation is incredibly important. So in this video, we're going to be going over how to value a stock, and to do this, we're going to be looking at 7 different valuation models. Each one provides different insights into how a stock can be valued. And it's very important to remember that valuation is not a science, it's an art. Each stock can look a little bit different. And like always, if you'd like to be able to download any of these completely automated spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, to start off, what we're going to do is we're going to come up here on this valuation spreadsheet and we're going to use Microsoft as an example. Let's say we want to find the intrinsic value of Microsoft. We'll come up here and plug in MSFT and hit enter. And you can see all the data is going to automatically load into the spreadsheet. Now, what we want to do over here is enter the most recent full fiscal year. And if we jump over to Seeking Alpha and look at what their latest quarter's earnings were, we can see their recent quarter's earnings was the first quarter of 2025. So what this means is they already have their full 2024 data. So if we jump back over to our spreadsheet, we can come over here and plug in 2024. And again, all this data will update. Now, the reason we did this is because these other valuations are going to be pulling data based off the stock and the year that we plug in on that stock screener sheet. So the first valuation that we're going to be talking about, the first of 7, is going to be known as Graham's valuation. And this is a valuation model invented by Benjamin Graham, who wrote The Intelligent Investor and is actually one of Warren Buffett's most important mentors. So let's go ahead and jump into it. To start off, we can see his formula right here. This is the formula he used to calculate intrinsic value. Now, it's since been revised, and the more commonly used formula is going to be this one right here. So let's talk about what's going on here. If we zoom in a little bit closer, we can see basically how we're valuing the stock in this scenario is we're taking the earnings per share for the company. So how much money does the company make? And then we're valuing it based on how much that earnings will grow, while also taking into account the current yield on AAA corporate bonds. So let's go ahead and get started with this first valuation. We can see here, the first thing we need is the estimated earnings per share for Microsoft. And this is where we have to remember that valuation is an art, not a science. Obviously, we don't know exactly what their earnings per share will be over the next year, but we can do a few different things. We can look at the company's historical earnings. We can look at analyst projections and growth rate projections for Microsoft. And if we come over here, we can actually use the ticker data function to find out what the estimated earnings per share for Microsoft is over the next year. What we'll do is we'll come over here and select Microsoft, select estimated earnings per share average, and then we're going to select the year 2025 and hit enter. And we can see their estimated earnings per share average is coming in at about 13.08 according to analysts. Now again, this is where you're going to want to do your own research and see if you agree with these analysts. But in this scenario, in this example, let's just go with 13.08. We'll come up here and plug this in. Now the next part is one of the most important. We have to apply a growth rate projection to the earnings of this company. And again, this is where you're going to have to do your own research. How is their industry growing? How is the company expecting to grow in the future? Has management given us any guidance? And of course, you can also cheat by looking at analyst projections. So for example, if we jump over to Seeking Alpha and come up here and look at earnings estimates, we'll come down here and scroll down and we can see earnings estimates appear to be in the upper double digits for the majority of the next few years. So if we jump back over to our valuation spreadsheet, let's say after doing a little bit more research, we come to a growth rate projection of about 15 for this company. We'll insert that. Now, the last thing we need is the current yield on AAA corporate bonds. And again, there's going to be multiple places that you can get this data, but in this example, we can just jump over to Moody's. We can see as of right now, the current yield on AAA corporate bonds is sitting at about 5.2. You can see it right here. So let's jump back over to our valuation spreadsheet and come down here and plug in 5.2 and hit enter. What we can see is the intrinsic value has automatically loaded in based off the formula that we have right here. And we come to an intrinsic value of $243.49 per share. That's quite a bit lower than the current share price for Microsoft. And I do want to point out, in this valuation, the result is going to be very sensitive to the current yield on AAA corporate bonds. The higher this number goes, the lower the valuation will go. So for example, if we jump back over to Moody's, Let's zoom in just a little bit more and look at what it's been like over the past few years. We can see for quite some time in the 2010s, the current yield on AAA corporate bonds was around 3.5 or even lower. So if we mess with the valuation, let's say that the current yield on AAA corporate bonds was closer to about 3. I'll plug that in, and you can see the intrinsic value jumps all the way up to about $422 per share. So again, the current yield on AAA corporate bonds plays a major role in this valuation. It's basically taking into account current market conditions. So this is our first valuation model. Again, this was invented by Benjamin Graham, and he talks about it in his book, The Intelligent Investor. But our second valuation is going to be one of the most famous valuations of all time, and this is one that Warren Buffett has actually talked about somewhat frequently, and that's the discounted cash flow analysis model. And the idea behind this valuation model is we should be able to value a stock based on how much free cash flow they're going to be able to produce in the future. Now, it looks like there's a lot going on here, but it's actually quite simple. Now, if you're using this specific spreadsheet to start off, you're going to want to insert the most recent quarter. And I'll come up here and plug in Q1 and hit enter. And basically all that's going to do is update some of the values. So again, when we're using things like a discounted cash flow analysis, you can see just why ticker data is so useful, because all of this data is able to automatically import into your spreadsheet, so you don't have to go to different websites and copy and paste it in. But if you are copy and pasting your data, this is where you want to start. To start out, you're going to come up here. You want to look at the company's historical free cash flows, because again, a company is worth however much free cash flow they're able to produce in the future. So what we're doing is we want to project how high of a growth rate the company is going to be able to get for their future free cash flows. And we start by seeing how the company has historically grown their free cash flows. So after you pull in the historical free cash flow for this company, you can do this at different places, but we can see the growth rates for the free cash flow. And for example, it looks like over the past decade, Microsoft's have an average free cash flow growth rate of about 14.36. Now, we don't want to just blindly go with that number. We also, again, we want to look at analyst projections, also see what the management team has been talking about as far as what they expect for growth rates in the future, and see how their industry is expected to grow. And at the end of the day, you have to come to your own growth rate assumption. So in this example, maybe we think Microsoft is going to grow their free cash flows at a rate of about 17% moving forward. So I'll insert 17 right here and hit enter. What we can now do based off of this is do a simple growth formula. Moving forward, we're going to use a 17% free cash flow growth and say that Microsoft is going to grow free cash flows at an average rate of 17% for the next decade. So you can see from 2025 all the way through 2033, we're projecting a growth rate of about 17% to the future free cash flows. What's next is the terminal value, and there's a formula laid out for this. You can see it right here, but essentially what we're doing is we're taking into account things like the discount rate and the perpetual growth rate, which is essentially the rate that we expect the economy to grow at in the future. And so the terminal value is going to be the sum of all the future free cash flows for Microsoft past the year 2033. So once we have all this data here, we have the future free cash flows of the company. This is what we can use to value the company. But we also have to take into account inflation over this time period and the time value of money. So what we do is we find the present value of those future free cash flows. What are those future free cash flows worth at this very moment? So we use a simple formula right here. Basically what we do is we take the free cash flow right here. You can see this is what we're looking at, 2025 projected free cash flow. And then we're going to divide it. And we're going to divide it by 1 plus K19, which in this scenario, that's going to be our discount rate. We're looking at the discount rate right here. And once we've done that, we're also going to raise it to B12 power. And what this is just the number 1. And it's telling us how many years into the future we are. So in this example, 2026, we're on 2. 2027, we're on 3. 2028, we're on 4, and so forth. So again, this is simply finding the present value of those future free cash flows. But once we've done that, it gets pretty simple. All we're going to do is add the present value of the future free cash flows together. So we have the sum of the future free cash flows right here. We added all this together here. But we also want to take into account the company's cash and cash equivalents while subtracting out total debt. So we add the company's cash and cash equivalents. Again, you're going to pull this from the balance sheet. So you can pull this from multiple places using ticker data, Seeking Alpha, or maybe even Yahoo Finance might provide this for free. And then we're going to subtract out the total debt. Again, you'll find that on the balance sheet as well. And once you've done that, you have the equity value for the company. So we're right at the end, only one more step. Once we find the equity value for the company, we're simply going to divide by shares outstanding. And we can see shares outstanding right here is sitting at about 7.4 billion. So we take equity value, divide by shares outstanding, and we come to a discounted cash flow price per share of $487 per share. So again, this is just an example. But in this example, we can make the argument that it looks like Microsoft stock is currently undervalued. And again, this is one of the most popular valuation models. This is one that most investors tend to favor. So now our next two valuations are going to revolve around what are known as multiples. So for example, the first one we're going to look at is a historical price to earnings ratio. We're looking at how the company has historically traded. How has the company historically been valued? So for example, if we jump over to our stock screener, if we come over here, we can see right here the price to earnings of the company. Let's zoom out just a little bit. But the price to earnings for Microsoft is sitting at 35.03. What does this mean? What this is doing is it's taking the current share price of Microsoft and dividing it by their earnings per share, and that gives us the price to earnings ratio. And this is important because it tells us investors are willing to pay right now about $35 for every $1 of earnings that the company generates. So because we can see how much investors are willing to pay for this company, it's basically a valuation method in its own. Now, some companies will receive higher price to earnings multiples just because they're able to grow their earnings at a higher rate, or maybe because it's a higher quality company that investors again are willing to pay a premium for. But what we can do is look at how the company has historically been valued with the price to earnings ratio, the historical price to earnings ratio. So again, in this example, we have a decade of data right here. What this is each year's price to earnings ratio for Microsoft. And we can see the average price to earnings ratio for Microsoft over the last decade is sitting at about 28.82. So that's how the company has been valued on average over the past decade. And again, you can find this data in different places, but I'm able to automatically import it into my spreadsheet with ticker data. Now, we can see for the trailing 12 months, the price to earnings ratio for this company is sitting at 34.87. 34.87 is about 21% higher than the average PE ratio over the last decade. So based on that information, Microsoft actually looks a little bit more expensive than how they've historically traded. So what most people will think, and it is true in some cases, that Microsoft is currently expensive. Now that might be the case, but there is more we have to take into consideration. Has anything about Microsoft fundamentally changed? Is the company able to grow their earnings at a higher rate, or have they somehow increased their competitive advantages? All of those could be potential reasons where Microsoft deserves a higher price to earnings multiple. But if nothing has changed overall, then you could easily make the argument it looks like Microsoft is overvalued compared to how the company has historically traded. And when it comes to this valuation, you don't want to just use the price to earnings ratio, there's other methods you can use as well. For example, we can base it off free cash flow metrics. We come up here and plug in MSFT on my free cash flow analysis sheet. We'll come up here and change the latest year to 2024. And there's plenty of information on the sheet, but what I want to pay attention to is these valuation metrics right here. Let's zoom in and take a closer look at the valuation metrics. We can see we have three: free cash flow yield, price to free cash flow ratio, and EV to free cash flow. Now, obviously, all these metrics are somewhat unique in their own way, but essentially what we're doing again is looking at how the company has been valued using these metrics over the past decade compared to how they're being valued right now. And it looks like in all three of these scenarios, the company looks more expensive compared to how they have historically traded, just like they were with the price to earnings ratio. So we've now looked at three different valuation models out of our 7, and the next one is actually going to be somewhat similar. We have what's called a multiples valuation model. Let's go ahead and zoom in and actually erase this data and just talk about what this is for a moment. The multiples valuation, again, we're going to be using a price to earnings multiple. And what we're doing when we look at Microsoft is not looking at how they're valued compared to how they've historically valued like we just did, but we're going to look at how the market is valuing them in comparison to how the market values companies that are similar in structure. So for example, maybe we think Apple's a stock that is somewhat similar to Microsoft. Maybe we think Meta is a company that's somewhat similar, and then maybe we want to pick Amazon as well. Now again, I want to be clear, this is just an example. In your analysis, this might not be the three companies that you think are most similar to Microsoft. But what we can do is we can see all the data right here is automatically loaded in. And the key metric that we need is going to be the trailing 12 months price to earnings multiple. And to be clear, you could also use the forward-looking price to earnings multiple. But what we're doing with these three companies, again, is looking at how the market is valuing them. So Apple has close to a 40 price to earnings multiple, Meta sitting at 28.82, and Amazon 47.36. That gives them an average price to earnings ratio for these comparable companies of about 38.7. So what we want to ask ourselves is, should Microsoft be valued at that average PE, the same average PE as these comparable companies? And if you've done the comparables fairly well and they are similar companies, then you could answer yes. So if we apply the same average price to earnings ratio to Microsoft, what that means is we take this number and multiply it by their earnings per share, we come to an intrinsic value of close to $459 per share, which is actually pretty close to the current share price of the company. Now, in some scenarios, you may get price to earnings multiples that are all over the place. There's a huge standard deviation. maybe in that sense, it would make more sense to use the median price to earnings multiple. So again, we have to remember valuation, not a science, it is an art. Each stock you look at could be unique in some way. In fact, it'll definitely be unique in some way. And when we talk about the multiples valuation model, there will be instances where companies can be very similar in structure, but one company may deserve a premium for some reason while the other doesn't. For example, if you look at Coca-Cola and run them through valuations, with a lot of valuation models, it looks like they're trading way above their intrinsic value. But the reality is people are willing to pay a premium for Coca-Cola because it's a business that's been around for so long. They have stable cash flows and predictable dividends, and a business model that stood the test of time. But this can be a very straightforward valuation, and you can get a very quick idea of if a company is overvalued or undervalued compared to how similar companies are currently being valued. So now we have 4 of our 7 valuations, and the next one we're going to look at is actually one of my favorites if we're looking at a dividend-paying stock, and that's because we're going to be looking at a dividend discount model, and it's actually somewhat similar to the discounted cash flow analysis. Instead of valuing the company based on their future free cash flows, we're actually going to value the company based on their future dividend payments. So the 2 key metrics we need to perform this valuation are going to be the growth rate and the discount rate. Now, to get the growth rate of the future dividends, we're going to do the same thing we did with free cash flow. We want to look at how the company has historically been growing those dividend payments. So you can see right here, we have quarterly dividend payments for this company and the yearly dividend payments for this company over the past few years. So this allows us to see the year-over-year dividend growth rates. And it's pretty clear they're consistently hitting about 10% dividend growth. And if you want to take it a step further, you can look at even more data. For example, if we jump over to my dividend breakdown sheet, come up here and plug in Microsoft stock. All this data will load in. And again, if we come over here, we can see dividend growth rates. They have a 10-year dividend CAGR of about 10.3% and a 5-year, again, close to 10.3%. So we reaffirm what we just looked at. And if we want to get even more in the details, we can see the company has a low payout ratio, meaning that high dividend growth rate should be sustainable right now. And if we look at the free cash flow payout ratio over time, what this is telling us is how much of their free cash flow is currently being used to pay out dividends. It looks like for the most part, it's been around 30% for the majority of the past decade, leaving plenty of room to reinvest back into the business, meaning it's easier to grow dividends. So in the scenario, I think, maybe around an 8, 9, or 10% dividend growth rate could make sense. Now we have to remember, in this valuation model, it's projecting the dividend growth rate for the entirety of the future, and eventually, most companies will start to slow down how much they're paying out in dividends. So you're typically going to want to do a slightly lower dividend growth rate than what you originally thought. So maybe in this scenario, we think an 8.25% dividend growth rate makes sense. With a discount rate of about 9%, we'd come to a dividend discount model price per share of $444.55, which is just slightly above the current share price. So now we've done 5 out of our 7 valuations, and on the spreadsheet, there's also actually an output tab, so you can easily see all 4 of the valuations that we used right here, not including the historical multiple valuation, since it doesn't technically give us a specific price per share. But what you can do is average all 4 of these valuations together to get an intrinsic value and also apply a margin of safety. So for example, since we think the current intrinsic value is about $408 with a 10% margin of safety, it's telling us our acceptable buy price should be about $367.65, so not quite within our buy range. But if we keep moving forward and look at our last 2 valuations, the next one is one I'm actually a huge fan of because I think it makes a lot of sense for different reasons, but it's also very straightforward and very beginner friendly, and that's going to be Bogle's valuation. So to start off, let's come up here and plug in the stock ticker Microsoft so all this data around us will load in. Now, as we can see, there's going to be 3 different aspects to Bogle's valuation. And Bogle's valuation doesn't actually give us a specific intrinsic value. Instead, it gives us the expected return of a stock, and you could do it over different time periods. And I'll talk about what it means in just a moment. So for example, for Bogle's valuation, we're going to need earnings growth. We're going to need the shareholder yield, and we're going to need to know what multiple expansion is. So the expected return is equal to earnings growth plus shareholder yield plus / minus multiple expansion. So let's go ahead and talk about this. We'll start with earnings growth. How fast is a company going to be able to grow their earnings moving forward in the future? And if you remember, when we looked at Microsoft earlier, we could see earnings per share growth rates estimates, and it's relatively high in the scenario. We could see anywhere from 10% to as high as 18% over the next few years. So again, in this example, maybe we think it's going to be a little bit on the lower end of those projections. We'll go with 11.5%. Again, this is just an example. I'll hit enter. We now have the first part of Bogle's valuation. But the next thing we need is shareholder yield. Now, you might not have heard of shareholder yield before, but it's actually pretty straightforward. If we come over here, we can see shareholder yield is going to be equal to dividend yield plus buyback yield. We have to remember, when it comes to free cash flow, there's 5 different things a company can do with their capital. They can reinvest back into the business, they can pay down debt, attempt mergers and acquisitions, but then they can reward shareholders in two ways: paying out dividends and buying back their stock. And that's known as shareholder yield when you combine the two. So in the scenario, we already know Microsoft has a dividend yield of around 0.73%. But what percent of their outstanding shares are they going to be buying back? Well, we can start to get an idea if we come down here, because we can see how much they're buying back each year. So it looks like in most cases, it's going to be less than 1%. And on average, over the past few years, it's sitting at 0.67%. So the company is buying back some shares, but it's not significant in the grand scheme of things. Now, I do want to point out, you don't want to just blindly go with this number. Always look to management guidance and see if they've given us any information as to whether or not they plan on increasing the amount of their buybacks. But with that being said, maybe we go with this number right here, 0.67. That's the amount we expect them to buy back. When we add these two numbers together, we get our shareholder yield. So now we have 2 out of our 3 elements to Bogle's valuation. We have earnings growth and we have shareholder yield. But then the last part is perhaps the most interesting of the 3. We have multiple expansion. What is multiple expansion? What is that telling us? Well, remember how we talked about price to earnings ratio earlier, which basically tells us how much investors are willing to pay for each dollar of earnings for a company. And remember how if we jump over to the historical multiples valuation model, we could see it looks like the company's trading at a higher valuation than it historically has. One of the things we may come to the conclusion is that we think this company is going to actually see not multiple expansion, but multiple contraction. So what this means is eventually investors are going to be willing to pay less for each dollar of earnings that the company produces. So let's just assume it's going to revert back to the average PE ratio that we've seen over the last 10 years. That would mean the PE ratio is going to come down by about 20 to 21%. That's pretty significant. So if we jump back over to Bogle's valuation, let's say that we're looking at this valuation based on a 5-year time period. We expect an earnings growth rate over the next 5 years, annually of about 11.5%, shareholder yield of about 1.4%, and then over the next 5 years, we expect multiple contraction of negative 20%. Now, we have to remember, since we're looking at this on a 5-year time period in this instant, that would mean about negative 4% multiple contraction each year. So I'm going to plug in negative 4% right here. Because again, since we're looking at it on a 5-year basis, 5 times 4 would come out to about 20%. And obviously, you can use Bogle's valuation on different time periods. But once we have all 3 of these aspects, we come to an expected return of about 8.9% for Microsoft with Bogle's valuation. Again, I'm a big fan of this valuation. It's pretty straightforward and it's not too difficult for beginners. And to be honest, I think it can actually be quite effective. So that leaves just one more valuation for us. And the last valuation is actually going to be what's known as a reverse discounted cash flow analysis. So just like earlier, we looked at a discounted cash flow analysis and we valued the stock based on how much free cash flow we expected them to produce in the future. Well, in this scenario, we're kind of doing the opposite. And this is actually something that Warren Buffett's business partner, Charlie Munger, was a big fan of. One of the things Charlie Munger was known for was saying that you should always invert to get to your solution. Now, what does he mean by this? Well, again, the idea behind a free cash flow analysis is we value the stock based on how much free cash flow they're going to produce in the future. And this is no doubt a great valuation model, but the problem that some people have is it can be very sensitive to growth rate projections. So if your growth rate projection is off by quite a bit, obviously you're not going to come to a clear intrinsic value. So how can we mitigate this? Well, one of the things we can do, again, use a reverse discounted cash flow analysis. And basically what we're going to do is see how much free cash flow growth is currently priced into the stock. So again, it's going to tell us how much free cash flow growth is priced into the stock. So for example, assuming 0% growth rate, 0% free cash flow growth, what we can see is based off our reverse DCF price per share, it'd still be worth about $126.05 per share. But the market is valuing this company at $424.56. So what is this telling us? Well, the market expects this company to grow their free cash flow. But the question is how much? Well, we can back into that number by projecting different growth rates and seeing what gets us to the current share price. So for example, if we come up here, let's plug in about 5%. If we plug in 5% free cash flow growth over the next decade, we'd come to a reverse DCF price per share of 182, which is still significantly below the current share price. So the market is definitely pricing in more growth than just 5%. If we bump it up to 10%, we start to get closer, bump it up even more, about 13%. We get closer, 15%, 375, and if we bump it up to about 17%, we get a little bit above the current share price. So let's bump it down just a little bit more to about 16.8. What we can see is we come very, very close to the current share price. So what is this telling us? Well, the market is pricing in free cash flow growth of about 16.8% to the future free cash flows for this company over the next decade. So what do we do with this information? Well, we have to ask ourselves one question. Do we think Microsoft can grow their free cash flow at a growth rate of 16.8% or higher over the next decade? Because if we do think that, then this company could be a good buying opportunity. But if we think the free cash flow growth over the next decade for this company will be lower than this, then this company's overvalued. So this valuation model doesn't give you a specific buying price, but it does give you great insight into how much growth the market is pricing into this stock. So we've now looked at 7 different valuation models, and we were actually able to run through each of these fairly quick simply because we were able to automatically import the data into our spreadsheets thanks to the help of the ticker data add-on. Now, if you don't have the ticker data add-on, you'll have to copy and paste this data into your spreadsheets that you built out, and there are different places you can find the data, maybe such as Yahoo Finance or Seeking Alpha. But again, if you do want to be able to automatically import stock financials straight into your spreadsheet or get access to any of the spreadsheets you've seen in this video, then you can just head over to tickerdata.com. Now again, I know I've said it many times in this video, but valuation is very much an art and not a science. Each stock is going to be different, and a lot of the times, the best valuation model will actually depend at what point in the business life cycle the company is in. For example, if we're looking at a company that's very early in their life cycle, a lot of the times a reverse discounted cash flow analysis could make sense. If we're looking at a company that's very mature, we could use the multiples valuation, look at how they've been historically valued, and how the market is valuing companies similar in structure. And in most cases, a discounted cash flow analysis can also make sense for most of these life cycles. So if you're brand new to valuation, here's what I tell you. You just simply have to get started. The more you dig into different companies, the more you're going to start to understand how they're being valued and why they're being valued that way. So go ahead and let me know in the comments down below if you have any questions whatsoever. I'll do my best to get back to you. If you thought this information was interesting, then I'd highly suggest you also sign up for the Dividendology newsletter. Once a week on Friday, I typically send out free resources and information designed to make you a better investor. But with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.